Today is Tuesday, December 15th, 2020. I'm your host, Max Gottlich, and we talk about my interpretations and insights on financial markets and the overall economy. So there have been many unexpected divergences from traditional market relationships. The US dollar hits a 2-year low, and asset allocators, they underweight dollars for the first time since 2013. So the US recently saw an unforeseen excess crude inventory of 15 million barrels. They weren't expecting anything remotely close to that huge figure. So the last time this happened, WTI crude futures actually slipped to negative territory in April. And yet the price of crude oil kind of continues to really surge higher, even though there's now a significant surge in supply, which means prices should go down, and there will probably, be even more buildups in supply going forward. So the Fed continues to expand their asset purchasing programs, although you'd think purchasing $120 billion a month in US Treasury bonds and mortgage-backed securities is already pushing it way too much. In fact, $1 trillion of treasuries are to mature, I believe it's within the next 15 days, right till the end of December, and another almost $6 trillion, I think $5.8 trillion is going to mature within the next year in 2021. So 30 million Americans are going to get evicted, and the CEO of the fresh IPO stock ticker symbol SNOW, SNOW, they generate almost 100 million, not they, the CEO generates almost $100 million a month from a compensation package. So disparities like these occur all the time. And these are obviously things that the media has been covering, not often, but enough to become aware of. And if we take a look at the next slide here, we'll see the S&P 500 performance versus corporate profits after tax all the way back to 1970, which is a year before gold got off the gold window, like we've mentioned in the previous videos. The diverging gap between the performance of corporate earnings and the stock market is really, really extreme, as you can see. So the central bankers are essentially leading investors over a very, very steep cliff. As you can see, asset price inflation is extremely, extremely real. Also, another interesting to note is today in 1886, the daily trading volume on the New York Stock Exchange exceeded 1 million shares, 1 million shares for the first time really ever in history. And today, billions and billions of shares, average of 2 to 5 billion shares are traded intraday, no problem. So it's just amazing to fathom about that. And when considering the put to call ratio, which it's a very high for index options and it's extremely low for individual equities, that seems as though, it basically seems as though investors don't have, they do have some sort of defensive boundary, right? They have a defensive boundary. And when considering this diverging relationship, it's kind of important to note that only 1 in 10 active managers actually see a somewhat consistent outperforming alpha. So stock picking is very hard, and it's extremely hard, almost near impossible to do it consistently, as studies have proven, versus active and passive investing. And with that being said, let's look at this chart here. It shows that 90% of all stocks in the S&P 500 are actually trading above their 200-day moving average. And this is really, really significant because the 200-day moving average is, for those that don't know, it's essentially an average price of the stock based on the average of the last 200 days of the stock trading. And you could do this with any number of days. You could do it within the last 10 trading sessions or 50, whatever you want. Now, remind you, and that depends on what time frames you use. Now, allow me to remind you that the 200-day moving average is a long-term price indicator. It's 200 days. So this saturation in the S&P as part of the search for yield mania has only happened 3 other times since the great financial crisis, as you could see. And also keep in mind, the S&P is currently trading at over 30 times PE multiple, which is very high. All signs point to an extremely overextended and overpriced stock market, but nobody seems to care to pay such high premiums for their investments. Nobody cares that they're paying such high premiums on their investments. And so, in fact, if we take a look at the next slide, the title is making me laugh. This supports the fact that retail investors or Robin Hoodies, aggregately speaking, or whatever you want to call them, they're all piling in as part of the search for yield mania and FOMO, fear of missing out. And look how much more overextended this growth trend is relative to the internet bubble. It's ridiculous. Historically speaking, December has been strong for the S&P 500. So, let's see if that historical trend continues higher into the new year, along with an increasing amount of zombie companies. So for those that are unfamiliar with the term zombie companies, I'm simply implying that these businesses cannot cover their debt servicing costs from current earnings over a pretty long period of time. So they have too much debt and leverage on their balance sheets and too little to zero cash. We are in a risk-on sentiment environment, folks. It's not just asset classes that are becoming buying frenzies, but it's also asset classes like whiskey and art and cars, things that people believe can replace their store of wealth and potentially generate price appreciation other than holding dollars. Right. So, in the next video, I wanted to really focus in on the ideology and conception behind the national savings and investment identity, which it essentially is the total of private and public savings, or rather government surpluses. So folks, I hope you enjoyed watching, and please subscribe and like the video, and understand that I am not a financial advisor, and everything I say is for educational purposes only, and not advice of any kind. So thank you so much, everyone. I'll see you next time.